With regard to Paris, I think what we're finding is that this flight to prime, this attraction to prime, is a very strong one. There is, I think, a concern that values across Europe for the secondary or the not prime stuff will probably go down a little bit in the next 6 to 12 months. I think that's a combination of the investment interest, the returns that investors require for their risk, and also the occupational side of where rents are going across all sectors, which takes us back to why Paris is particularly attractive. But I think also one of the other points we're finding across Europe is that a lot of the large, low yield, high value transactions that took place in 2006, 2007, the 5-year debt is coming towards refinancing or coming towards the end. I think that will have a significant impact because a lot of the buyers that were referred to in Olivier's presentation from the mid to late 2000s were very highly leveraged purchases. When we looked at the transactions the last 12 months in Paris, it's a lot of our sovereign wealth. I'm probably not so highly geared. So I think there's going to be a dynamic there, and we're seeing it in London and Paris and Germany, where the refinancing and the cost of refinancing and the impact that has on the yield, the initial return, will have an impact, I think. I think one other point I might just make, that what we're finding in Paris and London is that some of these prime owners will keep the assets for a long time. I think historically you would have funds or investors that might, whether it's an institutional investor, that over a 5-7 year period would then sell on, at value sell on. I think quite a lot of the international investors coming to Europe at the moment are long-term, and that means 10, 15, 20, 30-year owners. And that has an impact on liquidity. And in a way, probably in the Paris and London markets, that's going to make less prime assets available
for the future.
In the future, which again drives up probably the values of those assets, as Olivier was saying earlier, that come to the market.
That's good. Just one point from John's comment. In fact, when we have a look at the presentation of Olivier, for example, there is 3 assets which was very interesting, which was put on the market and buy. The first is Champs-Élysées, 52 Champs-Élysées, where is Virgin, and it was sold by Groupama to Qatar. And Groupama sold because they have some difficulties in Greece. So they have the constraint to sold. Eurosix sold 2 buildings to
NPS,
JP Morgan for dedicated investor. The same. Eurosix sold this building because they need money. So it's an opportunity for JP Morgan and for sovereign fund to buy this asset. It's around 500 million euros. And the third is the Qatar bought 2 buildings from Canam. Canam need to sell, so it's a reason also because they need to sell. They are the buyer. And with 3 assets, you have 1.6 billion of the 2012 market, which is something like 10% of the market. That's very important, in fact, to note that this kind of investment, the number of 12 or 16 billion investment from 2012 will be, we need to extract some type of building and financing. And those assets are very well financed today. So it's easy to finance this asset.
Yeah. Just perhaps a point regarding Eurosix deal. It's important to notice that actually Eurosix has some problems on deals, on buildings, and they put the building on the market, and actually they were not facing the price they wanted to have. So they decided to do a deal with JP Morgan, which actually was not the deal they initiated at the beginning. So like Philippe says, they put some building on the market, kind of distressed assets, and then they decide to sell core assets. I mean, now they have no problem. They are going to do their asset management job on the other assets, and they put them on the market when they will be ready, when they will be mature.